Cool. So I guess what we'll go ahead and do is get started. We are live on Facebook now as well. So welcome everyone to this week's edition of CRE 101. If this is your first time tuning in, we started this group back in about April of 2020. And the reason why we started it was because we wanted to create a forum and an environment where people could learn about commercial real estate topics. So really it's tailored towards investors, business owners, brokers, really anyone who has an interest in learning about commercial real estate. And today we actually have Aaron Zucker to talk about retail syndications, which I'm super interested in because that's one of my specializations is retail. So I'm interested to see how he's been able to really grow his fund over the last few years. So Aaron, welcome to the meetup.
Yeah, thanks for having me. I appreciate it. It's always good to meet and get to know new people. So if anybody wants to reach out after the fact, I'm pretty easy to find, but I'll throw my information in the chat as well, which is kind of an advantage to those of us who are on Zoom. And if you're on Facebook Live and want to connect with me too, happy to do that.
Oh yeah. And what I usually do, and I told everyone this as well. So we always record these meetings. So I always post it in the show descriptions on my YouTube channel. So if you guys want to check that out in the future, feel free to do so. I'll always also post his social links as well. He also does have a cool podcast where he talks to different people in the commercial real estate industry. So definitely worth a watch. So to start out, I mean, we usually like to learn a little bit about the people that come on. So if you could tell us a little bit about yourself and kind of tell us what got you into commercial real estate.
Yeah, sure. So again, my name is Aaron Zucker. I'm based in Charlotte, North Carolina. I have a company called ZIG, which stands for Zucker Investment Group. We specialize in buying value-add retail properties across the eastern half of the country that are unanchored. So they're either single-tenant net lease or 3 to 5, maybe 7-tenant strip centers. The avenue for us to making money is there's got to be some good story on lease up, whether if it's through vacancy lease up or repositioning or improving improving the NOI through taking below market rents to at market rents upon lease expiration, or through renewing existing tenants and restructuring deals with them that way. I started the company in 2018. We've bought 12 properties in 9 different states, ranging as far north and west as like the Cincinnati, Chicago region, as far south and west as Dallas. We've done a couple of deals down in Florida. And then of course, we've done some close to home as well here in not too far from here in Raleigh, North Carolina. So we're geographically agnostic. And I was always very bullish on being geographically agnostic when I started the company. My thesis on that is I'm even more bullish on doing so today as a result of this pandemic. Obviously, if you own exclusively properties in New York City, that would probably be pretty challenging over the last year. So geographic diversification is something that we continue to bet all in on, and it's something that I enjoy. And I think that's one of the beauties of owning retail properties. It's not an intensive management situation, especially when they're small and anchored retail deals like a multifamily deal or a large office building could be. So it seems to be working for us, and we're excited to continue growing. We are targeting to do hopefully 12 to 15 acquisitions this year, which sounds crazy to say out loud because it would double the size of the company, but it's something that we're equipped, willing, and able to do, provided that the market can cooperate for us. And that's why we're willing and able to hustle around town and do whatever we need to do to procure the right deals. So that's a little highlight on ZIG.
Oh, for sure. And again, dream big, right? You got to set big goals and make it happen. So that's awesome, man. So the premise of today's call really is related to retail syndications. Can you kind of give those individuals out there that maybe don't know what a syndication is, how exactly do you create a retail syndication?
Sure. So there's 3 ways to buy real estate, right? There's completely on your own balance sheet, which I've been fortunate to do a little bit of. Then the second avenue is through a fund model where I get everybody on this call to throw in $100,000 and we have a target. We have an idea of what we're going to buy, but we don't have a specific deal in mind. So maybe we raise $100 million to buy industrial deals in the Southeast at 6 to 8 caps. And that's our sandbox that we're going to play in and we're going to focus. And that's the mission of the fund. And then the third avenue to purchasing commercial real estate, which is the structure that we typically have at ZIG, is through syndication. And that's, we'll go out, we'll put a property under contract, or we'll work toward putting a property under contract. And I'll call Raphael, and I'll call Mike, and I'll call Richard and Jim and Marcus and say, hey guys, got this deal. What do you think of it? Here's the model. Here's how it's structured. Do you want to kick in 100 grand a piece at 500K in equity for a $2 million project and take it down and buy it? So that's the structure that we use at Zig. It's a friends and family model, meaning, I'm doing business with my friends and family, right? I'm calling, my sister who's done well in tech, or my friends that are brokers in different markets, which we do a lot of, and saying, hey, what do you think of this deal? Do you like it? Do you want to kick in? And there's advantages and disadvantages to both. The disadvantages of a syndication model like Zig's is, especially if you don't have great capital resources. We're fortunate where we do. In fact, we have more equity in the deals right now, so that's sort of our challenge. But the disadvantage in theory, if all things are equal, is you don't technically have the money earmarked ready to go when you're chasing a great opportunity. The upside to that is I've been an LP, a limited partner on deals before, where Zig is not the sponsor and I'm investing in somebody else's deal. And as an LP, for me, because I'm in the business maybe, and because, I'm very, I care about where my money's going, I like to know and touch and feel and see the deal and be able to selectively say, I like this Chipotle deal that Raphael is doing in Orlando, but I don't like the deal that Ernie brought me in Chicago. So I get to pick and choose. Where if I was invested in a fund that Raphael and Ernie own together, I'd be doing both deals, whether I like it or not. So selectivity for the limited partners is beneficial in the syndication model. And the other thing about the syndication model that I prefer as opposed to a fund model is deal structures can change, acquisition criteria can change. So in a syndication model, we've had our pref, which is the preferred return to the equity into the deal, shift on deals because, it might be a high barrier entry to market where the rent's below market. So our pref goes down on one deal, but it goes up on others because we're taking a higher risk tolerance. And therefore the people who are putting in the money should have, should be rewarded for the risk that they're willing to take. Whereas in a fund, what you're getting into on a structure wise, but you don't, and you have a pretty good idea of what you're getting into asset wise, but you don't have any say in that. So to each his own. I know plenty of people that I know, like, and respect that run fund models. And I've worked for companies that had fund models in the past. And it's certainly easier to scale that way because that the equity is earmarked and ready to go. For us, we're not short for people calling, I'm getting between 5 and 6 phone calls a day on average, I would say, from either repeat or potential new investors that are saying, hey, where's the next deal? There's no shortage of capital out there right now. So it's not a cog in the wheel that we've had yet. The cog in the wheel has been finding the appropriate deals to place that capital into. So for us, we prefer the syndication model, and it's been great thus far. And I think a lot of people, my limited partners, seem to be very pleased with the model thus far, given their appetite to want to come back for more. And the fact that if they pass on one, they can come in on the next one, and it's not really a big deal. It doesn't, it's no big deal because they're not missing out on the grand scheme opportunity, if you will.
Definitely. No, for sure. That's a great insight for sure. So as far as the syndication model is concerned, you've chosen to focus on the retail industry. Is there a reason for that? Is that primarily because of your background, or why exactly do you choose to go retail?
Yeah, I can get into the whole background if you want the grander version of my story, or I can kind of get into the Sports Center version. I'll start with the Sports Center version. If you want to dig deeper, that's up to you. It's your show. I'm just here to hang out. I spent my entire career in the retail sector working for shopping center owners. Some companies were large. The last one I was with before I went out on my own was a family office down in South Florida. And I was very motivated to want to own retail shopping centers. I always have loved retail. I think it's the most dynamic asset class. I'm going to probably offend some people when I say this, but I think retail is like playing chess, and some of the other asset classes kind of like playing checkers. There's a lot of moving parts. I've always used the example where you might be, and I'm sitting at the office that I'm in right now is on a corner location. So I always use the example when people come in that are learning about retail in general, that Starbucks would love to be in this, and they would pay whatever it takes to be on the corner that I'm sitting on right now, but they wouldn't go across the street if the rent was free. And the reason being is because this is on the going to work side, and people can make a right in and a quick right out, and it's quick accessibility going to downtown Charlotte. Whereas on the opposite side of the street, not as many people are drinking coffee at 7 o'clock at night. Sure, they can sell some coffee then, but Starbucks is hyper-focused and knows their business model on a macro basis. And that's why I love the nuances associated with retail. And I think that nuance makes it a higher barrier to entry asset type. And I think that additionally, coupled with everybody thinks that all retail is dying and that Amazon's taking over the whole world and no other retail merchant will ever open a store successfully again. I dispute that narrative all the time, but there's a selfish part of me that says, great, let it keep up, let it keep going, because it gives us at Zig better opportunities to buy deals at better yield. So, if that media narrative is going to continue to stay out there, I'm not really complaining, even though I disagree with it fundamentally. I'm still very bullish on retail.
No, I 100% agree with you. And that's one of the reasons why I decided to ask that, is because, like you said, retail is such a dynamic industry. And for that exact reason, it's higher barrier to entry. I mean, you can see a lot of content out there related to multifamily and various other asset types that are a little bit easier to understand and be able to get into. But in the case of retail, especially when you're talking about large corporations and everything else, I mean, there's a lot more sophistication involved. So it's kind of interesting to hear your take on that as to why you decided to go on the retail route. So.
Yeah, I mean, I read a lot and I study entrepreneurs and different not only asset classes, but different industries altogether. And one of the common underlying themes in what I read and study is that they are often saying, if everybody's going right, you should probably consider going left. Now, I'm not the only person who's bullish on retail, and our space is more than crowded enough for my liking as it is anyway. But in general, when people think about commercial real estate investment, industrial multifamily are certainly more sexy, if you will, right now. And even prior to the pandemic, retail was sort of like the ugly stepchild, even though and people were still really bullish on office and hospitality at that time. And I'm curious to see where that goes after the fact, but I'll take everybody else's crumbs that are left on the ground if that's how the marketplace wants to view retail.
Oh, for sure. And those crumbs are probably pretty sizable, I'd imagine. So that's awesome.
Don't need a lot.
What's up?
We don't need a lot of them. We just need a few crumbs. Just 12 to 15 a year is what we're looking for, like I said before.
I mean, that's awesome, man. Congrats. So as far as when you're analyzing opportunities, could you tell us a little bit about some of the criteria you look for? Obviously, you're not necessarily geographic specific, but I'm assuming when you start analyzing some of these opportunities, there's some things that you want to make sure are check marked before you start moving forward. So maybe if you could highlight a little bit of like what your thought process is when you're looking at opportunities.
Absolutely. So we talked a little bit before, the application of leasing to create value in the property that's non-negotiable. That's got to be the case. We do have capital that is patient. We will do deals that can take some time to monetize. There just needs to be an inverse relationship with the amount of time that it's going to take, which is high and not fun, with the amount of value that can be created on the back end. We're open. We can do 1-year flip deals. We can do 12 to 15-year holds. As long as there's real value to create through leasing, we're interested. As it relates to the markets, we talked before, geographically agnostic. We really like secondary markets. We play pretty well in the tertiary markets. We typically will stay away from like super sexy high street urban deals in Manhattan, San Francisco, LA, those types of markets. The thesis being is because we're located in Charlotte, that if all of the local developers and investors in those markets pass on the deal and it's being sent to me, something's probably really wrong with it, A. B, in order to operate and understand those markets and all the nuances associated with it, you really need to be there or at least have critical mass in those markets. And that's not our strategy. I'm more inclined to buy a well-located out parcel in Davenport, Iowa than I am the super sexy Main Street, or King Street is the name of the best street in Charleston, for example. It's just, I mean, we'll look at it, but it's not like we're very rarely competitive. And I'm very jaded in my approach because I'm always thinking, what am I really missing here? So we get really comfortable in the markets where there's patterns. We understand those patterns based on the bones of the leasing background in place that I come from. So we're totally, as far as market fundamentals go, we like places with an airport, but it doesn't need that much more. We don't need overwhelming density. As long as there's a call it 30,000 people or more in a 3 to 5 mile radius, we can play ball in those markets. Now, that said, by virtue of going into those markets, we need to be in a site there. We need to be at a great location, close proximity to big box retailers, Walmart, Target, first-in-class grocery stores. I mean, there needs to be a good story with that underlying real estate within those markets. Again, going back to what we're really chasing, ultimately what we're trying to do is take the NOI from what it is today, whether if it's zero or in-place income, and increase it. So the best way to get me excited about a deal is have some vacancy or substantially below market rents. You say one or both of those key phrases to me, you're going to get my attention, especially if the real estate fundamentals are decent or better.
That's awesome. That's great advice. And then also, I mean, you kind of mentioned the location aspect of things. Obviously, that's dependent on the use as well, right? Because, I mean, like you said, you're located currently on a corner where Starbucks would maybe be attracted to, but right across the street, that's not the case. So I'm sure there's wiggle room as far as what a good location and accessibility and visibility is.
Visibility is mission critical for us.
Mm-hmm.
Accessibility is too, and it's really important. I think it's 1B to the visibility being 1A. I think there's more tenants that can play around with that can compromise a little bit on accessibility, especially if the co-tenancy, meaning the tenants behind the out parcel, are strong or within the neighboring market. And typically in the markets that we're chasing, there's a higher tolerance for folks to make a left to go to Starbucks than there is in, a high, in Atlanta or Charlotte where traffic counts are insane and you may die making a left turn across the street. People are willing and able to drive when the market draws from a bigger trade area. So visibility is critical. Accessibility is still really important too. But ultimately it boils down to co-tenancy and traffic counts. I mean, if those things are there, we can lease it. As far as incomes go, if they're high, that's great. If they're middle or middle high, that's fine too. That we actually really play well in those markets too. Low to middle income's even fine too. To me, if you give me people, we can lease it. We just need to know who we're leasing it to. If there's no one there, there's no traffic for anybody. I don't care if you're, a gas station or Louis Vuitton. You got to have people. So that our strategy can sort of shift based on income levels.
So when you first got into the business of syndication, could you kind of walk us through maybe the first deal that you did, maybe some of the hurdles you had to overcome? Obviously, everyone has issues in any deal you're going to encounter. So maybe if you could kind of highlight some of that, your experience on that front.
Yeah, for sure. I'll never forget it. So I had invested, let me start by saying something that you did not ask me for, but I'm known to give unsolicited recommendations if I feel passionately enough about a topic. I believe that anybody before being a GP, meaning a general partner or a sponsor, should be an LP, limited partner. That does so many things. One, it gives you an education that you're, yes, paying for, but it's an investment, like truly an investment, not like, maybe this pays off one day, maybe it doesn't. Like in theory, if you write a check for X and you're investing in a commercial real estate deal, nobody's ever invested with the intent to lose money. So you could get a return and should get a return on X that's greater. So you can make money while getting an education. And if you're tied in closely with the sponsor, maybe that's an opportunity where, okay, if I'm going to invest in the deal, I know I'm a small partner. I'm going to be annoying though. Like, do you mind since I'm an LP, if I kind of see how you look at the model and talk to the lenders and talk to your partners and talk to the tenants? Like, people will do that. And if you're co-investing with a sponsor who says you can't do that with me, like, you need to rethink your strategy on investing with that sponsor anyway. So I would say is you take advantage of the fact that you're writing a check, have it turn from X to Y in a good way, get an education alongside with that sponsor. And also you'll get to look at how the limited partners view the deals. When we do our underwriting here there is a syndication play involved, which is 99% of the time, I don't even look at what the general partner returns are. I really don't until after the deal is like basically done until basically we've bought it. The reason being is I know as a sponsor, I'm making more money than the limited partners, right? We have a promote, we have fees, and nobody here's ever disputed our structures because we're creating value and we're not egregious in our ask. So I know if the limited partners are happy, by virtue of the fact that the general partner is making more money than the limited partners, as long as the limited partners are happy, the deal's a go. So that's how we underwrite deals in general. So I think that everybody should be a limited partner before going out on their own and doing a ton of syndications. If you have a great deal in the hopper and you feel like it's a once in a lifetime opportunity, do it. Maybe it makes sense to co-GP and bring a partner in, to each his own, depending on what your asset class is, size of the deal, et cetera. That's just my 2 cents on that. So that information leading into my first deal is important because I was a limited partner 3 times before I had gone out on my own and did a general partner deal, which we did. So we bought I'm like going to break out in hives telling the story. It was so stressful. I remember it like very clearly, also because it wasn't that long ago, but I'd been telling some select friends of mine in the business, which emphasizes the key of relationships, which we all know is critical. One of them being an investment sales broker out of California, who's one of my closest friends in the business to this day. I said to him, hey man, I want to go out on my own in the near future and buy value add unanchored retail deals. And you know how I look at real estate, you look at it very similarly. If you see anything, let me know. And he, we had looked at a ton of stuff. I'd flipped him deals, even though he was a broker. He said, I don't like it for you. You got to do the first one right. And then finally he called me one day after he knew that I was going out on my own. So it worked out really well. It was good timing. He was like, hey, I've got one for you. And it was an off-market single tenant net lease on the border in the Dallas, Texas market, specifically in Irving, which anybody can look at on our website. And the story was really good. It was outstanding real estate. The rent was dramatically below market rent. And it was a situation where he had an inside track with the seller and he was able to substantiate that the rent was below market because his firm was selling the other 11 out parcels to the shopping center. And the rents were like $185,000, $225,000 for like Hooters and Twin Peaks and Chili's and all these restaurant groups. And then on the borders over here paying less than $100,000. I'll put it to you that way. So going back to what we talked about earlier, that delta between market rent and when we could monetize the real estate was pretty wide. The tenant had only a year left on the lease, which was great, but they did have 2 5-year options that we were willing and able and expecting them to exercise, which they have done. And so we're just cash flowing the property today. But because of a potential 11-year hold period, we wanted to make sure that there was really a wide gap between what the tenant was paying in market, and that information was substantiated, and we ended up buying it. So I put the property under contract. I put up a deposit of $25,000. I had to put up a second deposit 30 days later, of which all $50,000 was going to go hard. And I just started calling everybody I knew that, I had a good Rolodex of friends and really friends and no family in the business, but just started calling friends and some family members saying, hey, I've got this deal. What do you think? You always talked about how you wanted to invest. And I made a ton of phone calls. I didn't, because everybody talks about, hey, I'd love to invest. But when the lights come on and there's a property under contract and there's a model in place and it's like, I need to know in the next week, like not everybody's real. And so obviously by virtue of doing 12 deals now, like I know who's going to perform and the repeat investors are coming back over and over. And so the amount of phone calls I'm having to make on each syndication is decreasing, which I'm very thankful for. And I have the best partners in the world for it. But at the beginning, it was hard to know because I didn't know who was a real partner and who wasn't. So I basically it was a $1.8 million deal, paying all cash because it was not financeable. There was only a year left on the lease. And I had a tight time frame by getting it off market from that seller who was sophisticated, not our ideal profile sellers. That was scary within itself. And I had the $25,000 up and I just started calling. I had like maybe $1 million to $1.1 million figured out in the first 30 days, but with a lot of fish, a lot of lines in the water to get people to put up the balance of the equity raise, which was still like 40%. And I think I'm most grateful for the fact that I was naive, because in retrospect, if I was really that behind on a raise, which we have never been ever since, if I was really that far behind on a raise moving forward, I probably would drop the deal. But because I was so bullish on the opportunity and believed in it and didn't really know any better and knew that I got another 30 days to figure it out, I had $50,000. Next thing I knew, I had $50,000 hard and had to go figure out the other $700K or $800K, whatever it was. And long story short, I ended up getting it done. I have 23 partners in that deal. which is more than usual. In general, it's more than usual even at Zig too. But that the lesson in the acquisition alone was worth it, and we're cash flowing, enjoying the property today, and looking to monetize it at some point in the hopefully not too distant future, but we'll see.
Yeah,
so that's the story. I was 50 grand hard before I knew what I was doing. So there's definitely an element of risk that anybody who's considering doing syndications or any commercial real estate investing has to be willing to stomach.
Oh yeah, that's great advice. And I've had similar experience. Well, I haven't had the acquisition experience or anything, but I had a property in a contract recently where I had that situation where it was my money was going to go hard if I did not pull through on it. So it's like one of those things where it's a different story once your money is on the line. So it's definitely good advice to share with people who are interested in going through that process. So you did mention sourcing deals and sourcing capital. I think a big part of the business is obviously those two components. And I remember I actually watched a interview with you and Beth Azor. Beth actually was on a call with us a while back, and you were talking about strategically targeting individuals at different conferences, or really just making sure you could leverage the relationships effectively through targeted relationship building. Can you kind of talk a little bit about maybe your strategy on that and how you've used it in order to essentially grow your business?
Yeah, I've been fortunate to take two, nothing original, but maybe not as commonly taken paths as an unanchored retail strip investor. The first of which is through social media. We've bought two properties from LinkedIn posting, which is free as far as financial investment goes. And one of our best deal that we've exited already, I would argue, was done through a broker who found me on LinkedIn because I post often on there. And she reached out to me and brought me an off-market deal that we bought and then sold 7 months later for a good return. And then another deal was bought that it's a Lululemon condo building in Cincinnati that we still own today. And that deal was brought to me off market just because somebody was like, I see this guy all over LinkedIn, and he reached out to a former colleague of mine from when I was with PEB, and thank God the guy at PEB vouched for me and got the deal, and here we are, happy-go-lucky cash flowing. So social media, just marketing but not selling, just saying, putting stuff out there, thoughts, thinking, just noticing trends, whatever, just interacting and schmoozing with people on there to kind of cast a wide net from a networking perspective. And then as a more micro, inch wide, mile deep approach, taking the personal relationships with the brokerage community really seriously. A lot of my peers don't return brokers' calls back. So, there's someone on here named Jose. If Jose was an investment sales broker and called me about a property and it was a 4 cap with 15 years of term left and above market rent, I would never buy that. But we take a lot of pride in calling Jose in this situation back because I don't know what else Jose has. And frankly, if Jose is a reputable enough broker to earn the listing of the developer or investor who put that deal together, then he probably sees a lot of other things. And so my thesis is it can't hurt to know him. If I spend 15, 20 minutes on the phone, who knows where that relationship goes? And one line that every broker who I've talked to has always heard me say is what do I need to do to get to the top of your list to where when you see that great deal, you think of us? Because I'm not naive enough to think that if you are an elite broker and let's say St. Louis, that you don't have 100 developers in St. Louis that you can call. And so we are very open and I would say, easy for me to say, but very liberal as far as giving incentives to brokers for bringing us deals. We're happy to include brokers in the ownership side. Whatever we need to do to get to the top of that list, as I mentioned before, we do it. And so a lot of the deal flow is coming through brokerage relationships on off-market transactions. And it's something that is going to continue to drive growth here. And now that we also have somebody who's exclusively focused on procuring deals on the acquisition side full-time, a guy by the name of Dan Sanfilippo. As I drop my pen, I apologize. A guy by the name of Dan Sanfilippo, he's procuring deals directly with owners and making several hundred cold calls a week. I'm bullish that we'll get to where we need to go by working the brokerage angle as well as going straight to owners and building rapport with those sellers who, just may be done with the assets and are looking to disposition them to a more entrepreneurial group group like us who's got a higher risk tolerance.
Definitely. No. And I think I value a lot of what you said, in particular on the LinkedIn side, just creating a brand. And I think that's part of the reason why I reached out to you. I mean, I saw you doing a lot of stuff on LinkedIn. I saw a few of your videos on YouTube and obviously your podcast as well. So it's one of those things where creating content that's valuable to people, putting yourself out there opens you up to new opportunities, and you know what type of relationships you can benefit from. So I think that was a great piece of advice.
Yeah, and I know the purpose of this call is to talk about retail syndications, and I don't want to divert from it, but I think for those of you who are on here, you're obviously interested in networking. If you're not on Clubhouse yet, assuming you have iOS, like iPhone, you need to get on it. That app is unbelievable. It's a way to instantly network with people. It's like podcasting and ICSC or any conference organization had a baby. And so I would highly recommend jumping on there if you haven't already. I'm done with the social media stuff because I know we're here to talk about retail syndication, but I just think between LinkedIn, Clubhouse, and Instagram, everybody should be on there and active. And I give you a lot of credit, Raphael, for putting this together. I mean, this is clearly a really cool platform, and I've already recommended it to a few people, and some of my friends have jumped on today who will probably follow it as a result. And this is now going to give you real credibility as somebody who's doing stuff in Louisville. So I appreciate what you're doing, and just another opportunity. Thank you for having me. Now we can jump back into retail.
No, and I appreciate your advice on the Clubhouse platform, because that's not one that I've explored a lot of yet, but I've seen a lot of people push it, and I feel like it is a new medium that could be very valuable to people. So it's definitely one of those things that I'm excited to start looking more into in the coming months. So that's awesome, man. So now that we understand a little bit about the retail syndication space, can you kind of tell us a little bit about how you see retail evolving over the next, couple of years? Again, it depends on the parts of retail, but if you could kind of highlight where you see over the next few years retail evolving as an industry.
Yeah, so the pandemic has done everybody a favor. It's stopped wasting our time. What I mean when I say that is the pandemic has expedited the inevitable. If you were a crappy retailer pre-COVID, COVID just made you go out of business faster, and you ripped the Band-Aid off for a lot of people. And people who didn't recognize that they had bad retailers in their portfolio or were doing deals with bad retailers, et cetera, are going to become exposed as a result of it. Pun totally not intended on exposed COVID, but anywho. And what it's also done is it's allowed the dynamic, nimble companies to evolve and shift and improve their business model or roll out brand new concepts altogether. And there's certain retail categories that are crushing it as a result of the pandemic as well. And obviously that has a lot to do with the current state of retail. Where I see it going is I see what, and nothing that I'm about to say is super original other than the fact that I agree with it, and you may not have heard it yet, but I think that a lot of retail stores are basically acting as distribution centers that are really pretty to the consumer. And I think what the e-commerce guys are learning is that that the retail storefronts are major necessities. I mean, you look at a retailer, and I don't know what the exact statistic is, but when you look at a retailer, when they close a location, a brick and mortar location, their online sales decrease pretty substantially within the zip codes that they've closed that store in. That's not an accident. And the consumer pattern that first comes to mind for me, based on experiences and talking to retail consumers, is I buy a sweater online from whoever, Nordstrom, and it gets sent to my house. If I don't like it, or it doesn't fit me or whatever, I want to be able to go to Nordstrom to either exchange it and see if it fits me the correct way, or if there's a different color that I prefer. And that opportunity and that right of foot traffic to Nordstrom is critical. And what's going to make the retailers that are strong for the long term survive and therefore thrive is when Richard or David or whoever walks into the store with that exchange, it becomes an exchange and then some, and they figure out a way to earn that customer's business and upsell them on other merchandise, or they provide a game-changing dynamic product like Apple does, like even some of the specialty grocery stores where, you go to Trader Joe's on Saturday morning and see what that place looks like and tell me retail's dying. It's false. It's not even remotely a narrative that makes any sense. So that's where I just think that the pandemic has expedited the inevitable, and I see retail just becoming more aligned in the seesaw where brick and mortar stores were carrying all the heavy weight prior to e-commerce, and now the e-commerce guys, either the independently only e-commerce guys need to match up with what retail are doing by adding retail stores, and the brick and mortar only guys need to incorporate e-commerce as a part of their business structure in general. Unless if you're TJ Maxx, Home Goods, in Burlington, where you don't need websites because your business model, or don't need outstanding e-commerce websites because your business model is predicated on getting an adrenaline rush out of the consumer, because when they go to TJ Maxx and they see that Ralph Lauren shirt for $29.99, that's $60 otherwise, and they can't get it anywhere else because there's no guarantee that all the TJ Maxxes in the country have it, then you have a dynamic retail brand there as well.
Oh, most certainly, yeah.
Like it, and I'm sorry for the rant, but like it basically boils down to the retailers that provide some sort of value, either through excellent customer service, excellent product, or discounted pricing, they're going to win. And if you don't offer anything dynamic to the marketplace, you're going to lose. I mean, you're seeing a lot, and I don't want to name any retailers, but these middle priced department stores that don't offer anything different product wise, they don't offer anything different customer service wise, and you can price match your stuff and it's 20% cheaper online, like Sears, for example, they lose, and they should lose because they don't provide any value to the consumer base. So a retailer, any retailer that provides a value proposition to the consumer will win, and those who don't will not exist anymore, and we'll be buying, guys like you and I will be buying their former spaces at pennies on the dollar, looking to backfill them with the next dynamic retailer who will come in.
Oh, for sure. No, definitely. And I mean, like you said, retail is not dead. And I think a big reason for that is, I mean, you look at even companies like Amazon that are incorporating a retail presence in their business model. And I think Beth mentioned a while back during the call that, if you were to look at like catalog sales in the 60s, that used to make up about 10% of all retail sales. But now e-commerce, most people think it's like 30, 40, 50%. But prior to the pandemic, I think it was like 6 or 7%.
It was so I remember when it was a hot trend at the Open Air Center conference, or no, this was Nexus in like 2017. I took notes that I still have in my tablet to this day. So it went from 7%, and the narrative was e-commerce is taking over the world, and it went up to 9%. And today, even during the pandemic, which you would think it would have exploded out of the water because all retail stores were closed for at least several weeks. Some are still closed to this day. Obviously, a lot have opened up since then. E-commerce sales are at 14, 15%. And I think that continues to grow up. I'm not naive to that. Mm-hmm. But to take over the whole world, you need to have more than 14, 15% of market share. I mean, yeah. And then you see the e-commerce giants opening stores, whether it's the little dynamic guys like Allbirds all the way up to the Amazons of the world. They're all opening physical brick and mortar stores. They're conceding, not that they were ever arguing, they're conceding to the fact that you have to have a retail presence. You have to. It's a distribution center that can get your top line revenue up on the short term and build a brand long term.
Definitely. That's some great advice. So as a final question before we open it up to Q&A, I always ask all our guests to kind of provide us with some of the top resources that you recommend as far as this particular topic, which is, retail and retail syndications, maybe podcasts, books, conferences, etc.
Sure. So for those of you who are in brokerage out there and like podcasts and are interested in retail syndication because you want to buy properties at some point, there's an interesting podcast out there called Broker Lord by a good friend of mine named Derek Walczek. Broker landlord type put together, in case you didn't pick up on that. Great podcast. He interviews one person in each state, and he's going through the process still. So he's only been through like 10 or 12 states where he interviews someone who's a broker turned landlord. Great stories, very relatable, I'm sure, to a lot of the people who are listening to this or on the Zoom call today. The best book out there that I've ever put hands on, and it was basically like my real estate Bible, Torah, whatever you want to use the analogy for, was a book called Investing in Retail Properties by Gary Rappaport. It can be found on ICSC's website. I just lent it to Dan, who I referenced earlier, who just started with us on the acquisition side. It's like a textbook, and I recommend treating it that way. This is not like entertaining nighttime reading. Like, if in order to get the most out of the book, which I spent plenty of time on the weekends when I was plotting my exit from PEB to go out on my own, taking meticulous notes on how to structure deals, and a lot of those principles are put into how we structure our partnerships at Zig. So that's the best podcast and book I can recommend as it specifically relates to the topic. And then I'd be a schmuck if I didn't say that if you're looking to hear good stories of people who have done it as well, listening to, there's some other podcasts out there like mine, Limitless, How to Crush It in Commercial Real Estate, where we hear about individual stories of kind of getting to the top of the business as well. So
definitely. And I'll vouch for your podcast. I listened to a few of the episodes, and great content. So definitely something you should definitely check out. So what I'll go ahead and do now is we'll open it up to Q&A. So if you guys want to plug away in the chat box right now, we're also live on Facebook. So if anyone on Facebook who has any questions, feel free to type it out and we'll ask away. All right, let's see. Check the chat box real quick.
Yeah, sure. Take your time.
Yeah, no worries. All right. So, it's Broker Lord. Yeah. So I think someone was asking about the
Broker Lord. Yep,
yeah.
By Derek Walczak. Great guy.
Awesome. Okay. Ernie, do you have a question?
Yeah, I was just curious how your typical waterfall works.
Sure.
One of your average investments.
Sure. So we just run a prep promote structure. We're typically in the 6 to 8% range on the pref, and then any cash flow or sale proceeds above whatever the negotiated pref is structured in a GP-LP split on the promote. Our promotes range, depending on the deal, from 25 to 35% for the GP, and then 65 to 75% to the LP's capital stack. So meaning if you put in $100,000 for the Nate pref deal at a 25-75 split, the first $8,000 a year prorated goes to you, and then anything above that, if, let's say there was a 9% return, the first 8% would go to you. That last 100 bips would get split. 25% goes to Zig, or 25 cents on the dollar, let's say, goes to Zig, and then 75 cents on the dollar would go to you, Ernie, as a limited partner. Does that clearly answer your question? I want to make sure.
Yes. And I assume you're using the PPM type format.
Yeah, we use just standard operating agreement. We've got language in there that basically says, hey, you're accredited. I didn't sucker you into doing this. I didn't hold a gun to your head, and you're capable of losing the money and it not affecting your life. And it's just very basic. Most people that are signing the agreement are very friendly with me, and I'm very friendly with them. And there's a good trusting relationship there that I'm not going to screw them, and they're hopefully not going to screw me either.
For sure. I had a question primarily related to more so, not necessarily retail syndication, but again, more so related to development. Is that something that you guys have considered doing long-term, or is that like a long-term strategy, or you really just prefer buying properties and then building them up or adding value to them and then kind of?
Yeah. So we do development. It's not, if it's a larger development, we'll certainly JV it. I'm fortunate to have great relationships with developers all over the country. So depending on where the asset is, we will do a joint venture in a development situation where we're typically running point on the capital stack and the leasing efforts, while the developer, our partner, will be running point on, or maybe we're working together on the financing side, but they're really running point on like due diligence and construction and entitlements and rezoning and all that. I know enough to be dangerous, but I also know what I don't know, and I know where we're really focused on trying to be experts in, and where we're not. We don't like to lose good deals, so that's why we'll JV those opportunities. And then we do buy vacant, older, dilapidated buildings sometimes, or even vacant, well-positioned new construction buildings. That doesn't matter. But if it's not a quick hit leasing exercise, then there is a redevelopment associated with it. We just make sure that we partner up with the best general contractors out there and accomplish what the tenants need in order to create value to the asset, get NOI in place, and not having to stomach the burden of the expenses associated with a vacant property anymore.
Oh, for sure. Definitely. All right. So Steve has a question. He said, what percentage of deals lose money? How is the loss distributed through to investors?
So great topic. We're fortunate, and probably because I haven't done enough of them and we haven't been doing a lot enough to really lose our butts on a deal yet. Deals do lose money all the time, of course. In fact, we often are buying in situations where the seller is losing money. However, there's a way to lose money in a good way. And if you're unfamiliar with the concept of cost segregation, I highly recommend looking into what a cost segregation study is. I think I saw on the website that you'd had Yona Weiss on here before.
He's coming in 2 weeks. So
good.
He should be,
okay,
he'll be
so
on.
I'm not going to steal his thunder because he's totally an expert, and I know what I don't know, and I've gotten intricately familiar with cost segregation studies over the last 2 years, and I've done probably 4 or 5 already, most of them with Yona. But you can show a loss. There's an avenue of, in this country, there's the way the tax laws are set up right now is if you buy a property and you get a cost segregation study done, what that study basically does is it values let's say you paid $1 million for a property and you've got a Chipotle on it, or a restaurant or a medical building where the improvements are expensive. What a company like Jonas does, and they do it very well, is they allocate a percentage of the property that goes towards the improvements and the percentage that goes towards the land. As a real estate investor, you want the land percentage to be tiny and you want the improvements percentage to be massive. The reason being is the way tax laws work in this country is land is not depreciable. You can't depreciate.
Right. No, you're right. You're right. Yeah.
Is that the right word? Depreciable?
Yeah, of course.
And the improvements on that land are, right? It's just like, if you buy a hood for a restaurant or a MRI machine for a medical facility. When you buy, it's just like a car. You buy it day one, it's worth X. As soon as you drive it off the lot or as soon as you use it a little bit, it's worth less. So you're able to depreciate that. And what you can do, and Yona will talk about this, if you're listening to me right now, best advice I can give you today is listen to Yona when he comes on in 2 weeks. Is you can take the losses on your tax return associated with the depreciation and offset income with it. So if you're cash flowing, so if you have a tenant that's paying you rent in a building that's $50,000 a year in rent in cash flow to you, and you depreciate greater than $50,000 on your cost segregation study in that year's tax return, you're showing a loss and can offset that loss in income against your other income from however you make money. If you're in real estate, it's unlimited as a real estate practitioner. So you can be putting money in your pocket in cash flow and show a loss on your tax return through cost segregation studies. Yona will explain it in a far more sophisticated, articulate way because he's an expert and he's a really bright guy. But as the end investor, that's all we're looking at. And I am a major advocate if you're holding on to properties long-term to do cost seg studies. So the answer to Steve's question is yes, you can show a loss and sometimes it can be a good thing.
For sure. Awesome advice. All right. So Frank, hey Frank. So he's asking, how do you typically handle financing, like your debt stacking?
Great question. Sometimes it's all cash because there's a quick trigger and the deal's not very financeable. I oversimplify our business all the time. People are like, oh, what's your hold period? We sell it when it's worth the most. How do you go about, leveraging and going with banks? Do you guys pay all cash? We try to only go to banks when we feel like we're in a good position to do so, when we have long-term leases in place, what have you. So for example, right now we're chasing a vacant 13,000 square foot building that's well located. In order to get the aggressive pricing that we're looking for, we got to close quick. And that's not vacant retail right now is not the most exciting thing to lenders, in case anybody hasn't picked up on that concept yet. So we're willing and able and prepared to have to pay all cash for that deal. And then once we get, the tenants that we want, like hopefully we get, Chipotle, Starbucks, Aspen Dental, all the sexy tenants, and have signed leases in hand, then we'll dangle those signed leases to a lender and say, now it's time to talk about a loan. And they'll be smiling ear to ear, excited to lend us money. So that's sort of conceptually how we do it. And then to get into with the redevelopments, Frank, we're typically not getting unless if we have unless we're doing like a preferred development situation, like we've done with my American Family Care business, which is a whole separate business that I'm in. We're typically not financing those. And then if they're cash flow deals, we're obviously very sensitive to getting good yield, good cash on cash returns. So that often involves having longer amortization schedules and lower equity injections. But at the same time, I'm going to talk out of both sides of my mouth here and say that we're also prudent about paying down the property. So we kind of blend that accordingly. So I hope that answers.
Oh, sorry. Oh, sorry. I think we accidentally muted you. Sorry about that, Ben.
That's okay. Frank, hopefully that answers your question. And if you have a follow-up, feel free to type it in the chat.
So actually a question off of that question. So is in the case where you're buying these properties all cash, what's usually the typical turnaround for getting the refinancing out? Is it one of those things where it's usually very deal specific?
Deal specific. Yeah. I hate that answer, but that is the truth here. Is really just depends on how quickly we can execute on the business plan. And believe me, no one's more motivated to get that done and uphold and continue to earn the right of having a good reputation as a sponsor than we are.
That's awesome. Good advice. All right. So if you guys have any questions on Zoom, feel free to chat away. I'm checking Facebook as well. We have a few people on there watching as well. Okay. Okay. So it looks like you answered all the questions that everyone had. First off, I just want to thank you so much for taking your time to stop by today and answer some questions that we had today. I think a lot of people in the group got a ton of value from it. And as I said before, we will be recording this. Actually, one second. I think I don't want to mess up your name, but let's say, depending on the deal, do you entertain CO GP opportunities as you being the lead sponsor?
Yeah. Co-GP opportunities are opportunities that we look at. We've done, I think somebody asked me yesterday, we've done 4 JVs of the 12 with, sponsors who have ridiculously sophisticated operating platforms and full accounting and property management. That ain't Zig. So we leverage them in those situations and their infrastructure. We do the heavy lifting on some of the JVs. So based on, if a brokerage shop brings in a deal and it's an overwhelming screamer and they have the ability and the willingness to really want to roll up their sleeves and get their hands dirty on the execution plan, then we're open to co-GPing those deals. So we absolutely entertain that to answer that question.
Awesome. Great advice and great information. So, okay. So what we'll go ahead and do is we'll wrap up. But I really do appreciate it again. Like I said, Aaron, for your time. How can people get in contact with you if they want to learn a little bit more about you and what you do?
Yeah, sure. So I typed my email in the chat earlier, but I'm pretty easy to find. If you go to our website, zuckerig.com, that's it's like Zuckerberg, but with no Berg. IG as an investmentgroup.com, or it's zuckerinvestmentgroup.com. Either way, it'll take you there. My information, if you go to the About Us, you can find some information on myself. I am on LinkedIn, and I'm the guy who looks like I do in my picture and looks like a 12-year-old. And I'm on Instagram as well, Aaron.Zucker, as well as that's my username for Clubhouse as well. And happy to connect with anybody at any time and pay it forward or share advice or look at deals. If you have anything, we're certainly active and willing and able to do so. And that would be the best way to reach me.
For sure. And like I said, I'll include his LinkedIn, Instagram, website as well in the show description notes on the YouTube channel. So for you guys who are watching us on YouTube, you just check the description and you guys can grab all that information. So again, thank you all for stopping by. We'll adjourn at 12:56. So
thanks, everyone.
All right, guys. It was good seeing you guys.
Yeah, Raphael, appreciate you having me. This was awesome. I really, really appreciate your time.
Oh, of course, man. Thanks again for stopping by, and we'll see you guys.